So here today, I have a sneaky goal today, and my goal is number one, I want to give you, how do I advance? There we go. What can I give you that no one else can, or very few people can? And how does that translate into profits for you? Because if I can do that, my hope, my sneaky goal is that you are going to send love letters to Roger and say, bring Kane back. We want more from Kane. And I'm going to blast through this presentation today. So there's going to be some stuff that we're going to miss today that if you like what you hear, then maybe I can come back and we can go over it in more detail and go on to other stuff as well. So the one thing that I thought that I could be able to bring to you guys, maybe that you're going to have a hard time finding from someone else, is the institutional mindset. And the reason is most people just don't leave institutions. One of the people that I work with that you guys didn't hear about yet was Mohammed El Arya. I don't know if you guys have heard of him, but he was at the IMF. Then he started at the Harvard Endowment Fund. Then he went to the IMF. Then he became the chief economic advisor of Allianz. Then he became the CEO of PIMCO. He was Obama's economic advisor. He's now the president of Queens College. The point is that when you're an institution guy, you're pretty much always an institution guy. You don't really leave. You just move on to other positions at other impressive institutions. So when they leave, it's probably because they retired and they're not coming out to teach people, especially not in public. They might teach their family members if their family members are interested, but they're not going to teach people in the public. So why do we need an institutional mindset? Well, one of my favorite motivational speakers, Zig Ziglar, said that you were designed for accomplishment, engineered for success, and endowed with the seeds of greatness. But what Zig Ziglar did not tell you was that you are wired to lose. And how can I say that? I know that sounds really harsh, but how can I say that? And very few people were born wired to make money. So if I take $100,000 and I take 1,000 people just randomly on the streets, and I give 1,000 people $100,000 with zero instructions, how many of them next year, at this time next year, do you think will have more than $100,000? I need to scroll down the chat.
That's
10%? You think if I gave people zero instructions at all and just handed them 100,000?
2%. 2%.
Yeah, okay. That's more like it because
2%.
Number one, most people are just going to go out and spend it. They're not even going to try to invest it or try to make more money off of it. Now, let's just say that I gave a little bit more instruction and I said, go ahead and invest it. You have to invest it or you have to start a business. You can't hand it to an advisor. You can't hand it to a professional. You can't buy into a fund. You have to invest it yourself or you have to go and start a business yourself. You can't buy a existing successful business. How many of those people after a year do you think will have more than $100,000?
Yeah, not a lot.
Not a lot. Very few people, right? So that shows me that we're all wired to lose. And it takes a lot of work to rewire it. And that's why everyone's story, including mine, including Rogers, including Busby's, everyone you talk to who is in the investing space, their story is maybe I had some initial success, then I lost a whole crap ton of money, and then I figured it out, and then now I make money, right? That's everyone's story. If you ask anyone, if you listen to any presentation, they had some success, they lost a bunch of money, and the ones who didn't give up at that point, they kept on going until they could figure out how to make money. They had to go through this process of rewiring themselves. And maybe you did the same thing. It's like, I followed this guru, then I followed this guru, then I followed this guru, then I followed this guru, because I haven't figured out yet how to make money. And I'm hoping that this guy can rewire me to make money. And so my goal today is at least to start that process of rewiring you. I can't do it in 10 minutes, but at least we can start the process. So we'll blast through this. These are different ways that institutions deal with bad wiring. And the main point here is that if you depend on randomness, you will get random results. You might get lucky and get to some good wiring and get some winning ideas in your head. But if you do that, number one, you're depending on luck and randomness. It's no guarantees. And if you arrive at that success randomly, you probably can't replicate it. So it might just be a one-time thing. Number two, you can't pass it on to others. So we all know a guru who seems to be really great at trading and making money himself. But if you try to follow him or you try to learn from him, you can't replicate those results. That's probably because he arrived at his success randomly. Like he doesn't have a systematic way of approaching it, and he can't articulate exactly what he does that makes him successful. And the disadvantage if you arrive at success randomly as well is that you have to spend a lot of time undoing the bad wiring that went in along with the good when you did it randomly. So if you listen to Roger in his boot camp and in other trainings, he says, if you're a complete newbie, this is going to be so easy for you because you're getting the right information right at the very beginning, and I don't have to undo any of the bad stuff. So we don't want to rely on randomness for success. We want to have a systematic approach to redo that wiring in our heads. And so we're going to do minor brain surgery today. I know I'm going very broad, but this is the institutional approach. You go broad to specific. Why does Roger in the morning, why does he start out with the overall markets? Why does he look at bonds? Why does he look at all these other things? And but he spends maybe 5 minutes on the stock and he spends an hour on all the other stuff. It's because we're going broad to specific. And this is the institutional approach. So we're going to remove some bad wiring. We're going to add in some good wiring. Some of it will make sense to you, but the most important thing is some of it will feel very, very wrong, because if you're used to something, you're hearing it over and over again from other people or from your education, and you've bought into it, the right information is going to feel wrong to you, and you might immediately reject it. So keep an open mind and just trust that I wouldn't be here if Roger didn't feel like I was qualified. So hopefully I'll live up to that, and you guys will send him love notes and ask him to bring me back. So 5 ingredients for brain plasticity, because that's what we're doing here. We're building new neural pathways. Your brain literally has to be rewired with new nerve endings and new neural pathways in order to get you to think habitually in a different way. So real quick, this, because it's not directly related to trading, but protein, hydration, blood flow, those are things that your brain needs in order to grow. And blood flow can be exercise, but maybe you're just getting really excited right now that hopefully I'm going to share some life-changing information for you guys. And you're starting to get a little bit excited and you get that blood flow too. Then we need new information and the right thinking. And this is what Roger is super good at. And this is why you guys keep coming back to him, because he has new information. He has information that you haven't heard from anyone else and is the right thinking. It's the right way of thinking, which is why he has success, which is why he has so many of you guys replicating his success. So let me ask you guys, in the trading pit, what is the secret to success in the trading pit? We were just talking about how he has a 95% win rate, which is super impressive. So what is his secret to success in the trading pit? No one? He tells you patience, timing, education, there's probability. Those are all good stuff, but he tells you in all of his presentations, when he talks about the trading pit, one of the very first things he says is, you get to see what institutions are doing in real time. That is critical. That is critical. This is something that is unique to the trading pit. So most people talk about beating Wall Street or beating the markets, and Roger's talking about following the institutions. This is a different type of thinking. This is trying to beat Wall Street, trying to beat the markets. That's the wrong thinking. What we want to do is, how do institutions think? How do we think like them? And how do we use that to find success? So this is going to be a minor segue right now, because you'll see how this comes into effect. But one of the most important things that I learned as a institutional trader and portfolio manager was the secret to predicting the future. And I know we don't trade on predicting the future. We don't trade on predictions, but we prepare ourselves and we point ourselves in the direction of the prediction. And that will dictate how we start to trade. So we still do want to be able to quote unquote predict the future, but also prepare in case that prediction doesn't come true. Remember statistics, right? Remember the skeleton board, right? I can count on this happening, but in case it doesn't, one of these happen instead of the ones in the middle, then I'm prepared for that. So how do I know things are going to fall in the middle? With what percentage point? So the secret to predicting the future is population times policy equals the future. If I know who I'm talking about and I know what their policy is, their general guideline for behavior, then I can predict what they're going to do. If I know that this person is a banker and he opens the bank every single morning, well, I can pretty much predict that tomorrow morning at 9 a.m. he's going to be at that bank, right? So the population and their policy dictates the future. If we add one more piece of it, if we add in the procedure, then we know how things are done. And that gives us the roadmap to that future. So if I know he's a banker and he goes to the bank every day at 9 a.m., but I know he does it by driving his car down a certain road, now I get a really clear picture of what is going to happen, and I can prepare myself for that and take advantage of that. And when it comes to trading, it means that I can prepare myself for profits. So there's a lot of different types of institutions. People don't talk about this. There's insurance companies, pension funds, mutual funds, endowment funds, hedge funds, all sorts of different types of institutions. So let's take a look. Now that we have that framework, how does the trading pit, how is it successful? Number one, what's the population? We're following institutions. And for the most part, from what I can tell, we are following the largest institutions, the insurance funds, the pension funds, the hedge funds, maybe a few others as well. But for the most part, we're following that really, really big money in the trading pit. And the policy of these institutions are to take programmatic accumulation at fair value and programmatic distribution at an inflated value. And the way that they do that, one way that they do that, that Roger has taught us, is the VWAP accumulation and distributions at known supply or predetermined targets. Now, that's not how he trades every single day. You can't see these things in like every 2 minutes, but he's taking, remember, this is the procedure of the institution, not how we take advantage of their procedure and their policy and their population. So if we understand the institution's behavior, then we can have amazing win rates like Roger does at 95% win rate. So there is one institution that people hardly ever talk about, and that is who's that? Well, who is part of every single trade? Anyone? Anyone have a guess? Who has to participate in every single trade? Citadel, right? Market maker, exactly. Citadel is a market maker, but yeah, the market maker. And so the market maker, let's take a look at them. So our population now is the market maker. What is their policy or what is their business model? They make markets in a specified instrument, which means that they carry an inventory of cash and assets, and they make money on the bid and the ask. We were just talking about this a few minutes ago, that quote unquote, the asshole that we were talking about with the really wide spreads. So they don't take directional bets or speculative positions. They just make that bid ask spread. So there's something different though about an options market maker. They do carry cash, but what's different about them is they have to write every single call and put. When you go and you buy a call, they have to write that call into existence. You get the call long and they get to the call short. They have the exact opposite position as you. This is different than a stock market maker or a bond market maker or any other market maker, because those market makers can say, oh, you have a seller of the bond, here's a buyer of the bond, and I can just match them and I don't carry any inventory. But an option market maker doesn't have that capability. They have to write every single one. And so to hedge themselves, they have to carry the underlying asset in order to remain non-directional, because remember, they can only make money on the bid-ask spread. They're not trying to make money directionally or speculatively. So they hold a huge amount of risk if they just carry a whole bunch of short options. Can you imagine like NVIDIA, when people were buying calls like crazy on NVIDIA, the option market maker was short calls of NVIDIA, huge amounts of calls. So they had a huge amount of risk. And because of that, they would have hedged away the risk by making large purchases of that NVIDIA stock, underlying stock, and they're generally hedging themselves to that 50 delta. Can the market makers lose their money? Yeah, market makers can lose their money, but if they're good at what they're doing, it's really, really tough because they're constantly hedging themselves. So really, it shouldn't matter to them. If they're doing their job correctly, then they're so well hedged that they're not going to really make money if the stock goes up or the stock goes down. All they care about is that bid-ask spread, that 1 penny or 5 pennies, or in the case that we saw earlier, like $5 between the bid and the ask. That's all they're making money on. So it's difficult for them to lose money if they're hedged well. But in a highly traded stock like NVIDIA was earlier this year, the market maker's hedging activity can actually represent a really, really big volume. And as we say, the tail begins to wag the dog. Normally, the option price follows the price of the underlying. But when you have someone making huge stock purchases or huge stock sales because of options activity, well, the option starts to dictate the price of the underlying. So they 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 hedge away their risk and delta, but they still have gamma exposure. And I'm not going to get too much into this because I don't have a lot of time. But what happens is we create gamma pockets because the options market maker is forced to defend the position by selling and buying the underlying stock. We create things that are called gamma pockets, or I call them gamma pockets. And ironically, their hedging activity oftentimes shoves the underlying market towards the price that they're defending against. So you'll see stocks pin at a certain strike. So a lot of times, one explanation of why a stock stays at a certain price is, well, oh, we're consolidating. We're consolidating. But why are we consolidating? A lot of times it's because the market maker is being forced to hedge their position at that particular price. Why? Because there's a huge open interest at that strike. So they're hedging their, and so that pins that price at that strike. And then when does it release? When does it finally release? It releases at options expiration. So a lot of times, just pay attention. I have some charts and examples, but I'm not going to have time to go through them. Just pay attention. Find a chart where something is trading sideways, and then when does it release? It's going to be oftentimes right around the options expiration. So what that means is that these gamma pockets act like magnets, sucking the stock to a particular price. And that means that if we know this is happening, then we also know when it will move because of the options expirations. We have a time frame of when that will move. And so now suddenly we have the policy, we have the population, the policy, the procedure, and we can predict what is going to happen. And we can then have a huge number of strategies that will take advantage of that information, just like Roger has a huge number of strategies to take advantage of what institutions are doing. Sometimes he takes it at the VWAP. Sometimes he takes it on a momentum surge. Sometimes he does all sorts of things, right? Once you understand the overall behavior of the institution that you're following, then there are a lot of strategies that you can come up with. So here's an example. Let me see how much time I have. What's special about tomorrow? Does anyone can tell me what's special about tomorrow?
Option expirations.
Option expiration. Yes, options expiration. So let's see how understanding the market maker, the policy, and their procedures can equal profit for us. I realize that we're over 12 o'clock right now, so maybe I was going to hopefully do a bonus trade or example, but maybe I won't have time to do that. So let's just say there's a large expiration coming up. What that means is that there's a huge amount of shorts and short calls and puts that will disappear from the market maker's book. So remember, if just say it was NVIDIA and there's billions of dollars being bet on NVIDIA long calls, Well, the market maker has billions of dollars of exposure short those calls. But on options expiration, all of those calls disappear. What's going to happen to the market maker? He's going to be holding a whole bunch of NVIDIA stock with no short position against it. And now he's directional. And he's violating his policy. So that is going to force the market maker to unwind his positions. So what you'll see is that if there's a huge expiration and uh, and there's a low likelihood of the people who are in that asset actually wanting to roll their position, then the market maker is going to be suddenly really exposed on the underlying asset, and they are going to engage in a systematic selling or buying if they were short that underlying asset. But on Monday, you'll see a lot of selling pressure in that stock because the market maker is trying to exit his hedge. So over a few days, you'll see that selling pressure happen. And so I was going to give potentially a bonus trade or an example of that happening, but
Why don't we,
hopefully,
why don't you come back like next Tuesday when we'll, figure out next week and we'll just continue this. This is
yeah,
fantastic. And it also, what I'll do is I'll record this, separate it from today's room, post it in the VIP room and in my Telegram channel. And it's also time for you to start creating your own YouTube channel and posting these videos in there as well. So but isn't this fantastic, guys? This is this is like completely like totally different. This is institutional stuff. This is the kind of stuff. Remember what I always tell you? Try to figure out what institutional traders are doing. Guess who you're talking to? Guess who's in front of you? An institutional trader. Guess what I used to be? An institutional trader. Folks, this is stuff you're not going to get from CNBC. People are loving it, man. Really loving it. The feedback is fantastic. And he's just, Kane is just like scratching the surface. Oh, he's going to be back. Kane is going to be back many, many, many times. So you and I will figure out the next session, Kane, maybe in like beginning of next week sometimes. So we can
yeah,
keep this
that'd be
ball
great.
rolling and you could do you could show this. But what I want you to do, Kane, is I want you to set up a YouTube channel, or I'll set up a YouTube channel for you so we can start posting these videos on there and start posting them on start posting your Telegram link here for people, and you can start posting some ideas. Wouldn't that be great, guys? Wouldn't you love to have Kane's Telegram channel? And wouldn't you like to have all this recorded and get more of this? Wouldn't it be great to hear this kind of stuff all the time? Yeah, look at that. They're loving it, man. They're loving it. Can you tell the difference between the guys who want to be gurus, who talk loudly, and people who actually know what they're doing? This is a guy who actually knows what he's doing. All right. There's a big difference. All right. All right. Thank you for joining us. Matt will do seasonality tomorrow. Kane, thank you very much. This was fantastic. Hey, guys, if you want Kane on again, say yes in the chat. Let's see how many yeses we get. Look at that. Oh, my goodness. There's a lot of yeses.
Racking up. Thank
That's a
you
lot
guys.
of yeses.
Thank you.
A lot of yeses. That's what I thought. So you are very much loved. Perfect. Perfect. Yes, 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 yes. Everybody says yes. Do I bring you guys the good stuff or what? All right. All right.